The only 5 expenses that actually determine your financial future. Here is something I noticed in 25 years of sitting across from real people at real kitchen tables. The ones who were struggling financially were almost never struggling because of small decisions. They were not undone by restaurant meals or subscription services or the occasional splurge. Almost without exception, the financial pressure they were carrying traced back to one, two, maybe three large decisions they had made years earlier, decisions that had seemed perfectly reasonable at the time. And here's the part that stayed with me long after I retired from advising. Most of those people had spent far more energy managing the small things than they ever spent examining the big ones. That gap between where the attention goes and where the money actually goes is what today's video is about. I want to walk you through the 5 categories of spending that genuinely determine your financial future. Not the ones that feel important, the ones that actually are. And I want to show you why getting even one of these right, just one, does more for your financial life than years of careful, small dollar discipline ever could. If you are 55, 60, or somewhere in that stretch where retirement is starting to feel real rather than theoretical, this conversation is for you specifically, because the window to adjust these decisions is still open. Not forever, but right now it is open. Stay with me through the end, because I am going to show you a simple 2-step audit you can do this week, and I will tell you exactly which number to check first. Here is something strange about how our brains work. Small purchases feel painful. Big ones feel abstract. You debate a $35 lunch. You glance at a $500,000 mortgage, check that the monthly payment fits, and sign. You agonize over a $12 streaming service. You roll a $48,000 car into a $700 monthly payment, remind yourself you need a vehicle, and drive away. This is not a character flaw. It is how human psychology is wired. Small numbers feel concrete. You can picture $35 leaving your wallet. Large numbers become abstract. Your brain cannot hold $500,000 as a real thing, so it converts it into something manageable, a monthly payment, a general category, a decision that feels already made. A researcher named Morgan Housel wrote about this pattern and put it simply: the amount of attention a problem receives is often the inverse of its importance. We obsess over the $150 decision. We spend 3 minutes on the $150,000 one. In 25 years of working with pre-retirees, I watched this play out over and over. People who tracked every grocery receipt had no idea what their total housing costs had been over 20 years. People who had canceled every subscription they did not use were still carrying 2 car payments that were quietly reshaping the retirement date they had in mind. The goal today is to rebalance that attention, to look clearly at the 5 categories where the real financial decisions live, and to help you see each one not as a source of guilt, but as a lever. Because if even one of these is out of alignment, adjusting it will do more for your financial future than almost anything else you could do. Let us start with the biggest one. The 5 expenses that actually matter. Your home. Most people think of their home purchase as a single decision. They chose a house, they got a mortgage, and that chapter closed. What I want you to see today is that it never closed. It is still running. Every month, every year, quietly shaping everything else in your financial life. Here's the math, and I want you to hold it for a moment rather than just to let it pass by. A $600,000 home at current mortgage rates, roughly 6.3% on a 30-year fixed, does not cost $600,000. By the time the final payment is made, it costs closer to $1.34 million. That one decision, made on a Saturday afternoon after a 45-minute walkthrough, carries a price tag that most people never fully calculate. Now picture a side-by-side comparison. 2 households, identical income, identical savings habits. One buys at $600,000, monthly payment around $3,714. The other buys more modestly at $450,000, monthly payment around $2,785. The difference is $929 a month. Call it $1,000 for simplicity. That $1,000 a month is not a rounding error. It is $12,000 a year. Over 30 years, choosing the more modest home saves roughly $184,000 in interest alone and cuts more than $330,000 off the total cost of the loan. But here's where it gets personal for anyone approaching retirement. That $1,000 a month, redirected for even 10 years into a retirement account, does not just sit there. At a modest 6% return, it builds toward a number that meaningfully changes what retirement looks like. It is the difference between a retirement date of 63 and a retirement date of 67. It is the difference between retiring with margin and retiring with pressure. The home is not just a lifestyle decision. For most Americans, it is the single largest determinant of when and how comfortably they retire. And if you made this decision years ago and the number is what it is, that's fine. We're not here to revisit the past. We're here to look clearly at the present and ask, given where I am, what can I actually do? That question always has an answer. We'll come back to it. Your car. Or usually your cars. Here's something that surprised nearly every client I worked with on this. Most people, when they think about their car expenses, think about the car payment. They do not think about the pattern of car payments, the continuous cycle of financing one vehicle, trading it in before the loan is retired, rolling the remaining balance into the next loan, and beginning again. That pattern, extended across a working life, is one of the quietest wealth-reducing habits in American households. Consider this. A $600 monthly car payment invested instead at a reasonable 7% annual return over 35 working years grows to approximately $1.24 million. Of that, you would have contributed around $294,000. The remaining $950,000 is compound growth, nearly $1 million from one monthly decision. Most families carry 2 car payments, which means this is closer to a $2.5 million lifetime decision than a $700 a month one. Now, I'm not suggesting you should never buy a car or never finance one. Cars are not optional for most Americans. The question is not whether to buy, it's whether to buy on a cycle that never ends. Think about what a different pattern might look like. You finance a modest vehicle over 3 years, you pay it off, and then, instead of immediately trading up, you drive it for another 5 or 6 years with no payment. During those years, that $700 goes somewhere else, into a retirement account, into an emergency fund, into breathing room. The typical American will buy somewhere between 8 and 10 vehicles over a lifetime. The financial difference between buying 10 and buying 8, combined with extending the payment-free years in between, is not trivial. It is directional, and over decades, direction is everything. Health insurance and medical costs. This is the category most retirement planning conversations underweight, and the one that tends to create the most financial stress for people in the years right before and right after they stop working. Here is why it matters so specifically for you if you are in your late 50s or early 60s. Medicare begins at 65. If you retire at 62, which many people do, either by choice or because of a job change or a health issue, there is a gap. 3 years where you are responsible for your own coverage. Individual health insurance in that gap, depending on your state, your age, and the plan you choose, can run $800 to $1,500 a month in premiums alone, before deductibles and out-of-pocket costs. That number alone can push a retirement date back by 2 or 3 years for someone who had not planned for it. Not because they made poor decisions, simply because they had not included this specific line item in their retirement income plan. Employer-sponsored coverage is one of the most valuable financial benefits in the American workforce, and one of the least discussed in those terms. When an employer covers 70 to 75% of family health insurance premiums, that subsidy has real dollar value. For a family plan, that can represent $12,000 to $18,000 per year that your employer is spending on your behalf. When you leave that coverage, you are not just losing a benefit, you are taking on a cost. You cannot control everything about healthcare. No one can. But you can plan for this gap. You can look at your projected retirement date and ask, what will coverage cost me between that date and age 65? That number should be in your plan before you make the final decision about when to stop working. And beyond insurance, investing in your own physical health is not separate from financial planning. It is financial planning. The cost of preventable chronic conditions in retirement is not theoretical. It shows up in out-of-pocket expenses, in reduced mobility, in quality of life. Every reasonable investment in your health today, in sleep, in movement, in managing stress, is also a financial decision. One of the better ones available to you. Childcare and education expenses. I want to take a moment here because I know this section may feel like it belongs to a different season of life for some of you watching. Your children may be grown. Childcare may be years behind you. But education costs, specifically the question of how you supported your children through college and whether that support involved depleting your own retirement savings, is a conversation that still matters for a lot of people in their late 50s and 60s, because the decisions made during those years are still part of the financial picture today. For families currently in the middle of this era, I want to say something clearly. Childcare is not a line item. It is a financial era. For families with young children, full-time childcare can cost $1,500 to $3,000 a month, depending on where you live, comparable to a mortgage payment in many parts of the country. That era does end, but it reshapes savings trajectories for years. College is where the decisions compound most significantly. The average cost of a four-year public university for in-state students is now roughly $27,000 per year, including room and board, according to the College Board. Private universities average closer to $58,000. A family that pays full price at a private school for 4 years is making a $232,000 decision, often without the same deliberation they would bring to buying a home. There are paths through this that preserve both the student opportunity and the parent's retirement security. In-state public schools, community college for the first 2 years, merit aid negotiations. Most private universities discount heavily from their sticker price, and after scholarships and negotiated aid, many families pay 50 to 55% of the listed price. And trades. The skilled trades offer strong income, genuine job security, and a starting line free of student debt. The deeper point here is not which path is right. The deeper point is that this decision deserves the same deliberate analysis as a home purchase, and it rarely gets it. Now, here is the part many people overlook, and it happens so gradually that most people do not notice it until it is already well established. This is lifestyle inflation. Not a dramatic financial event, not a bad decision, just the steady, almost invisible habit of upgrading everything as income grows. It starts reasonably enough: a better car when you get a promotion, a larger home when the family grows, nicer vacations when the kids are a bit older, dining out more because you have earned it and you enjoy it. Every one of these individually makes sense. The compounding effect is where the problem lives. Upsizing a home by $150,000 is not a $150,000 decision. When you add interest over 30 years, property taxes, insurance, and maintenance, that decision can cost $300,000 to $400,000 over the life of the loan. And if that upsizing happens at 48 instead of 42, 6 years closer to retirement, the compounding time left to offset it is meaningfully shorter. Cars follow the same pattern: upgrading more frequently, always carrying a payment, moving to a higher payment on the next vehicle. Each step feels modest. The cumulative effect over 15 years is not modest. This is not about never upgrading your life. You have worked hard. You should enjoy the life you have built. The goal is intentionality. The meaningful question is not, can I afford this upgrade? The question is, if I make this upgrade now, what does it cost me in retirement flexibility 5 years from now? When that question becomes part of how you evaluate large spending decisions, the math tends to produce different answers. I want to pause for a moment because we are about 5 minutes in and I want to make sure what I'm saying is landing the right way. None of this is about restriction. None of it is about living smaller than you deserve. What I'm really talking about is alignment, making sure the big decisions and the life you actually want to be living at 67 or 70 are pointed in the same direction. So let me ask you something, and I want you to actually hold this question for a few seconds before you move on. When you picture your retirement, when you genuinely picture it, what does it look like? What does a regular Tuesday look like? Where are you? What do you have the freedom to do? Now hold that picture, because that is what these 5 decisions are either funding or quietly working against. That picture is what we are really talking about. Let me tell you about someone I worked with, because this is where all of this becomes real rather than theoretical. Her name was Renee. She was 61, a school librarian from Akron, Ohio, and she had spent 33 years building something she was genuinely proud of. She had $312,000 in her 403B. She owned her home, not paid off, but close. She had 2 grown children. She was 3 years from the retirement date she had been picturing since her early 50s. When she sat down with me, she was calm, organized. She came with a folder. But about 20 minutes into our conversation, she said something quietly that I've heard more times than I can count. She said, "I don't actually know if what I have is enough. I think it might be, but I don't know." Not a crisis, not a catastrophe, just a specific, persistent uncertainty she had never been able to fully answer. She had done the general math, she had run the rough numbers, but she had never looked clearly at the 5 categories we are discussing today. Not all of them, not in relation to each other. What we found when we looked together was not dramatic. Her home costs were manageable, her cars were reasonable, but she had one thing she had not fully accounted for: the coverage gap. She planned to retire at 63. Medicare would not begin until 65. She had estimated $400 a month for individual health coverage in those 2 years. The actual current market cost for a plan comparable to what she had through her employer was closer to $1,050 a month. That gap, $650 a month, $7,800 a year, $15,600 over 2 years, was not catastrophic, but it changed her plan, not by years, by months, and it changed her confidence entirely. Because once she could see the real number, once the uncertainty was replaced by something she could actually plan around, everything else settled. She told me at the end of that second meeting, "I feel like I can breathe now." Not because everything was perfect, because she finally knew what she was actually working with. That clarity, that specific shift from approximate to actual, is exactly what examining these 5 categories is designed to give you. Here's the truth we don't say clearly enough. Cutting subscriptions is fine. Cooking at home more often is fine. Being thoughtful about small daily purchases is a perfectly reasonable habit. But if even one of your 5 major expense categories is genuinely out of alignment, if your housing costs are stretching you thin, if your cars are carrying payments that never seem to end, if you have a healthcare gap in your retirement plan that you haven't calculated, if education decisions created debt that changed your savings trajectory, no amount of small dollar discipline closes that gap. This is not discouraging, it's clarifying, because it means your energy is most valuable when it is directed at the 5 categories that actually move the needle. And once those 5 are examined and adjusted, the rest of your financial life becomes significantly easier to manage. So what do you actually do with this? There are 2 practical steps, and neither one requires a financial advisor or a complicated spreadsheet. Step 1 is the audit. Look at each of the 5 categories and ask one honest question about each one. Housing. Is my total monthly housing cost, mortgage or rent, taxes, insurance, maintenance, something I could sustain comfortably on my retirement income? Not my current income, my retirement income. Cars. Am I always carrying a payment, or do I have stretches of payment-free years? If I have not had a payment-free year in the last decade, that pattern is worth examining. Healthcare. If I retire before 65, what does coverage actually cost in my state? Have I put a real number in my plan? Not an estimate, a researched number. Children and education. Are there decisions from this era still affecting my current savings rate? Is there a loan balance or a contribution pattern that was interrupted that I have not fully recalibrated from? Lifestyle inflation. Over the last 5 years, has my savings rate kept pace with my income growth? Or has the gap between income and savings stayed roughly the same while the expenses expanded to match? You do not have to fix all 5 today. Fixing even one, even partially adjusting one, creates more financial momentum than a year of small dollar discipline. Step 2 comes after the big 5 are examined. Once those levers are in reasonable alignment, then the smaller decisions matter, not as survival strategies, but as refinements. Subscriptions, dining habits, impulse spending. These are worth attention when the foundation is stable. They are not substitutes for building the foundation. Here is the organizing idea I want to leave you with, because this is where everything we covered today connects into one clear picture. Every financial decision you make lives somewhere on a spectrum between low impact and high impact. The lattes and subscriptions live at one end. The home, the cars, the healthcare plan, the education decisions, the lifestyle trajectory, those live at the other end. What makes the high impact end so powerful is not just that the numbers are larger, it's that these decisions repeat. They don't happen once and end. They happen every month for years, quietly compounding in one direction or another. One thoughtful adjustment in any of these 5 categories will do more for your retirement readiness than everything at the low impact end of the spectrum combined. That's not an opinion. That's arithmetic. And once you see it clearly, you cannot unsee it. Before you close this video, I want to ask you to do one thing. Pick one of the 5 categories we covered today, just one, and find the real number. Not the approximate number you carry in your head, the actual current number. For housing, that means adding up your full monthly cost, principal, interest, taxes, insurance, and a reasonable estimate for maintenance. For cars, it means calculating what you have spent in loan payments over the last 5 years, not what you budgeted, what you actually paid. For healthcare, it means looking up what individual coverage actually costs in your state for someone your age and comparing it to what your employer currently covers. One number, 15 minutes. It will tell you more about where you actually stand than an afternoon of general financial planning ever could. If something in this conversation helped you see one of these categories differently, if a number landed in a way you hadn't expected, I would genuinely like to hear it. Drop it in the comments. I read them. And if someone you care about is working through these same decisions, send this to them. These are conversations that are always easier when you're not having them alone.